In this video, we'll be concerned with growth and growth strategy. Now, a business needs to grow in order to maintain its competitive advantage over its rivals. If it doesn't grow, the rivals will become larger and more dominant and more competitive. The rivals will constantly be looking for innovation and change and product development, entering new markets and developing new ways of working. So it's important for companies to look at what the rivals are doing and to look at their opportunities that are in front of them for development. So businesses are constantly looking out for ways in which to grow, ways to develop, and ways to secure their position within the market. There are various sources of corporate growth that we may consider. Clearly, innovation and invention are sources of growth. These are development and discovery. Well, innovation is what businesses tend to do. They tend to look critically at their processes to try to develop new, more efficient, more cost-saving processes. They also look at their products to see what innovations can be made to their products which will enhance their position in the market. And also invention, coming up with an entirely new product, an entirely new way of working, not based on anything in the past, just a completely new way of working. That would be invention. So these ways enable businesses to grow. But entrepreneurship, alertness to opportunity, as it's defined by one famous writer, Israel Kirzner, entrepreneurship is important because it's entrepreneurship that's looking for gaps in the market. It's a predisposition that some people have got. Some people are alert to opportunities. They look to the market, they look to what customers are doing, they can see opportunities perhaps that others can't see. And they're constantly in a search for new products, new ways of working, new ways of doing things, entering new markets, developing markets, and this is the way businesses can grow. But they can also grow through economies of scale. Scale in economics means size. So larger companies have competitive advantages. Larger companies can negotiate discounts on the purchase of raw materials and various goods. They've got perhaps advantages in distribution of their product. It's easier for them to ship their product because they're able to use specialist transport or even negotiate discounts with carriers. They're able to negotiate discounts at banks on loans, have advantageous rates for borrowing. They're treated differently by the banks as well. They get more of a reception when they go to the bank. So they're able to employ specialist machinery. I could go on with the list. They can have specialist labour, specialist departments, and so on. So there are many advantages to economies of scale, and these advantages mean that the firms can produce the product cheaper and hence make itself more secure in the market. So there are various sources of growth that we can identify. There are two types of business growth, really. There are the internal, or sometimes called organic growth, and external growth, which would be mergers and acquisitions. So the internal growth, or the organic growth, well, this refers to growth financed out of retained profits and shareholder reinvestment. So it's growth that's financed out of the company's own resources, or perhaps the shareholders are asked to put in more money to finance some new development. Efficiencies are sought to develop internal economies with a view to increasing the return on investment. The management are constantly looking for efficiencies, and the benefits from the efficiencies could be used to finance internal growth. So organizations prefer to grow from internal sources if they can, because it means they don't have the burden of borrowing from the banks or the obligation of trying to go through an expensive method of raising finance. They can do it themselves out of their own resources. The problems with internal growth, well, the sources of internal finance may be insufficient to fully implement the plan. Medium-sized companies don't, generally speaking, have a lot of spare resource, and the profits that it makes may be used to maintain the plant machinery, perhaps engage in some more marketing and invest in additional machines or additional training for the workforce. So it doesn't have a lot, generally speaking, to make big investments. So there's a problem of financing internal growth from internal sources. The implementation of plans based on this source of financing may have to be spread over a long period of time. So if companies can afford to grow from internal sources, they may have to plan for it over a long period of time to try and make sure that they've got the resources to spare, and that they can manage the company and manage their cash flow over a long period of time while they're recovering from making the investment. Competitors will be aware of the plans and possibly capable of offsetting any advantage. So the competitors may be aware of the plans. They will see what the company's doing, and they may step in and try to beat the company in the race to get new products to market or to develop the markets. So the competitors won't stand idly by just watching a company grow. They will try to do something to outcompete the company. External growth. Well, the main focus in this case is on business size and position in the market. Various sources of finance may be used in this context. Mergers and acquisitions, where companies try to merge with other companies. So two companies come together, and this way they get economic growth. Or it could be there are acquisitions. A company may grow, and instead of investing in entirely new plant and new processes, it acquires an existing company, and in that way it grows. It could form alliances and mutually beneficial trading relationships. Possible that it simply forms an alliance with another company, a trading agreement with another company, and they trade to their mutual advantage. That may be a possible way of getting growth. Franchising, that's another way. The company may look at its product and think it's suitable for franchising, and then look for investors who want to produce the product elsewhere, perhaps overseas. Perhaps it's a part of the globalization move. But it looks for investors who will then pay the business a certain amount for each item produced. Or they might pay the business a license fee once a year for the right to produce the product elsewhere. Of course, the business will have to train the people and make sure that they then understand the product and understand the market and the trading arrangements and so on. But it could be a way of raising finance for growth. It could be a new share issue. That's a possibility. The companies may simply ask shareholders to put in more money, to invest more, or they may issue new shares on the stock exchange, let's say, and hopefully people will buy the shares, and if they buy the shares, the company will receive a percentage of that and use it for investment purposes and for growth purposes. So there are various ways in which a company can grow. It can grow internally from internal resources, or it could grow from external resources. The external ones are the ones we've got on this slide at the moment: mergers, acquisitions, forming alliances, franchising, or new share issue. These are the most common. But the internal ones means retained profits are used for reinvestment purposes. No matter which way the company goes, there are problems, because the competitors will know what it's doing. And the competitors, as I said earlier, will not stand idly by. They will respond to this and try to inflict damage on the company by producing more products or cutting the price or doing something to upset the plans of the business. Well, that's all we're going to deal with in terms of growth. It's a short class. It's just looking at the different types of growth that are possible and the sources of revenue for growth, internal and external. That's all we're going to deal with, so I'm going to leave it at that and say thank you for watching.